A backtest shows a factor that seems to predict returns. But is it real? Often, it is just confounding bias. Why conditional association is not causation, and how to fix it. Imagine a quant researcher discovers that stocks with high momentum have higher future returns. The backtest shows a strong correlation. But is momentum really causing the returns? Or is it just a proxy for something else, like market cap or volatility? This is the core problem of confounding bias. In this scenario, momentum stocks might also be small-cap stocks, and small-cap stocks might have higher returns due to a size premium. If the researcher does not control for size, they might mistakenly attribute the size premium to momentum. This is a classic example of confounding. The observed association is real, but the causal interpretation is wrong. To avoid this, one must use causal inference techniques that account for confounders. Otherwise, the factor may fail when the market environment changes. To measure the true causal effect of a factor, we define the average treatment effect, or ATE. It compares the potential outcome if a stock had the factor versus if it did not. In an ideal experiment, we could observe both, but in reality, we only see one. The ATE is the difference between the expected return under treatment and the expected return under control. For example, if we could magically make a stock have high momentum and then observe its return, and also make the same stock have low momentum and observe its return, the difference would be the causal effect. However, we cannot observe both outcomes for the same stock. This is the fundamental problem of causal inference. We must use statistical methods to estimate the ATE from observational data, which requires adjusting for confounders. When we simply compare the average return of stocks with the factor to those without, we get a biased estimate. The bias comes from the imbalance of confounders between the two groups. For example, if high-momentum stocks are also small-cap, and small-cap stocks have higher returns for other reasons, we attribute that extra return to momentum. This is the bias in conditional association. The naive comparison does not account for the fact that the two groups differ in other ways. To get an unbiased estimate, we need to balance the confounders across the treatment groups. This can be done through matching, weighting, or regression adjustment. Without such adjustments, the estimated factor return is likely to be overstated or understated, leading to incorrect conclusions about the factor's profitability. One way to correct for confounding is inverse probability weighting, or IPW. We estimate the probability that a stock receives the treatment given its confounders, called the propensity score. Then we weight each observation by the inverse of that probability to create a pseudo-population where confounders are balanced. For example, if a stock with high momentum has a low probability of being in the high momentum group, because it is small cap, we give it a higher weight to represent the counterfactual. This weighting creates a synthetic sample where the distribution of confounders is the same across treatment groups. Then, the weighted average difference in outcomes gives an unbiased estimate of the ATE. IPW is a powerful tool, but it requires a correct model for the propensity score. If the model is misspecified, the estimates can be biased. Many factors that appear significant in backtests fail to deliver in live trading. The reason is often that they were capturing a historical pattern of confounding, not a true causal relationship. When the market regime changes, the confounding pattern disappears, and so does the factor's predictive power. For example, a factor that worked because it was correlated with small-cap stocks might stop working if small-cap stocks underperform. The factor was never truly causal, it was just a proxy for size. This is why out-of-sample performance is crucial. If a factor is truly causal, it should persist across different market conditions. If it is only a statistical artifact, it will likely fail. Causal inference methods help identify factors with genuine economic mechanisms, making them more likely to survive out of sample. Let's compare the naive estimate of a factor's return with the causal estimate after adjusting for confounders. The naive estimate might show a 5% annualized return, but after controlling for market cap and volatility, the effect could drop to near zero. This illustrates the importance of causal adjustment. The naive estimate is simply the difference in average returns between the treated and untreated groups. The causal estimate is obtained by adjusting for confounders using methods like IPW or regression. The difference between the two is the bias due to confounding. In many cases, the bias can be substantial, leading to false conclusions about a factor's profitability. By using causal inference, you can get a more accurate estimate of the true effect, which is essential for making informed investment decisions. This bar chart shows the contrast between the naive and adjusted estimates for a hypothetical factor. The naive estimate is 5%, but after IPW adjustment, it drops to 0.5%. The difference is the bias due to confounding. The chart visually demonstrates how a factor can appear profitable but actually have little to no real effect. The naive estimate is misleading because it does not account for confounders. The adjusted estimate is more reliable because it balances the confounders across treatment groups. This example highlights the importance of using causal inference methods in factor research. Without adjustment, you might allocate capital to a factor that is not truly profitable, leading to underperformance. The chart is a stark reminder that correlation does not imply causation. Modern causal inference uses machine learning to estimate the propensity score and the outcome regression, but with a twist: Neyman orthogonality. This allows the ML models to be flexible without introducing bias, and the resulting estimator achieves the fastest possible convergence rate. Neyman orthogonality is a property that ensures the estimator is robust to small errors in the nuisance parameters. In practice, this means you can use complex ML models to capture nonlinear relationships without worrying about overfitting bias. The estimator remains unbiased and has optimal statistical properties. This is a significant advancement over traditional methods that require parametric assumptions. By combining ML with causal inference, you can handle high-dimensional data and complex interactions, making it possible to estimate causal effects more accurately in real-world financial data. Double machine learning estimates the treatment effect by first predicting the outcome and the treatment using ML, then regressing the residualized outcome on the residualized treatment. The Neyman orthogonality condition ensures that the estimator is robust to regularization bias. In the first stage, you train ML models to predict the outcome and the treatment based on confounders. Then you compute the residuals, the actual outcome minus the predicted outcome, and the actual treatment minus the predicted treatment. Finally, you regress the outcome residuals on the treatment residuals. The coefficient on the treatment residuals is the estimated causal effect. This approach removes the confounding bias by orthogonalizing the treatment with respect to the confounders. It is called double because you use ML twice, and it is robust to errors in the ML predictions, making it a reliable method for causal inference. This table lists common confounders that can bias factor research. Market cap, volatility, and industry are the most frequent. Liquidity and book-to-market are also important. Ignoring these can lead to false discoveries. Market cap is a classic confounder because small-cap stocks often have higher returns due to a size premium. Volatility is another because high-volatility stocks may have different return patterns. Industry can matter because certain industries may have higher returns due to sector-specific risks. Liquidity affects returns because less liquid stocks may require a premium. Book-to-market is a value factor that can be correlated with other factors. If you do not control for these confounders, you might attribute their effects to your factor of interest. This is why it is essential to include them in your causal model. For investors, this means that a factor's backtest performance is not enough. You need to ask, is this factor capturing a real economic mechanism, or is it just a proxy for something else? If you don't control for confounders, you may be taking on hidden risks. For example, if a factor is actually a proxy for small-cap exposure, you might be inadvertently increasing your portfolio's sensitivity to small-cap risk. When small-cap stocks underperform, your factor will also underperform, even if the factor itself has no causal effect. By using causal inference, you can identify factors that provide genuine diversification and alpha. This can lead to more robust portfolios that are less exposed to hidden risks. Investors should demand causal evidence before allocating capital to any factor. In summary, confounding bias is a silent killer of quant strategies. The difference between correlation and causation is not just academic, it is the difference between a profitable factor and a mirage. By using causal inference methods, you can separate signal from noise and build more robust portfolios. We welcome your thoughts on causal methods in finance. The key takeaway is that you must always question whether a factor's predictive power is due to a true causal mechanism or merely a statistical artifact. By applying rigorous causal inference techniques, you can improve the reliability of your factor research and avoid costly mistakes. Thank you for watching, and we look forward to your feedback. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.